Population growth, advanced manufacturing, and logistics demand keep Phoenix locked in as one of the most active industrial markets in the Southwest. But the rapid, unbridled expansion of the past few years has passed. Phoenix industrial real estate has entered a more selective, normalized phase. Because of that transition, relying on a single overarching vacancy rate to gauge market health is a trap for investors looking at 2026. A single massive distribution building sitting vacant in an outer growth corridor artificially pulls the metropolitan average upward. Filter out that speculative edge, and you find a dense network of smaller infill suites holding steady closer to the city center. A high-level vacancy percentage is only a starting point. It cannot serve as a complete thesis. Broad metrics lie by omission. To uncover the true risk profile, investors must separate the data by specific product type and submarket. The first step is breaking the word industrial into two distinct categories: large format big box distribution centers and multi-tenant light industrial properties. During peak market periods, developers rush large warehouse projects into the pipeline. When those massive projects finally deliver into a more cautious leasing environment, vacancy numbers naturally spike. This diagram represents the concentrated risk inherent to big box distribution. A large warehouse often relies entirely on one or two major corporate tenants. If one corporate tenant leaves, the income disruption is sudden and severe. Small bay properties serve a completely different ecosystem, housing local operators, contractors, and specialty trades. Here, income is spread across a diversified grid of many businesses. If one tenant vacates, the overall structure and income mass remain intact. Tenant turnover in these spaces is inevitable, but spreading income across a dozen businesses makes the financial impact highly manageable rather than devastating. A macro-level supply glut does not hit every building equally.